Thanks for staying with us. Of course, you're watching Finweek Money Matters. Remember, this is the show that helps you manage your finances. International institutions like the World Bank and the International Monetary Fund project South Africa's GDP growth for 2016 to be less than 1%. At the same time, the rand has weakened markedly against the major currencies, and we want to find out if there are any compelling reasons for investors to take their money offshore. With me in studio to discuss the cases for increased offshore exposure are Andrew Morton, Head of Product Enablement at FNB Financial Advisory, Mark Lindheim, Chief Investment Officer at Investment Solutions, and in our Cape Town studio is Urvesh Desai, Global Equity Manager of All Mutual Investment Group's Macro Solutions Division. Gentlemen, lovely to have you in studio. Urvesh, let's start with you in Cape Town. Everybody seems to be talking about offshore. What is the compelling reason to do so, and what should one consider before they even decide to diversify their portfolio?
Look, I think with offshore investing, everyone's talking about it at the moment because of the rand. So the rand has weakened significantly with good reasons, but I think to be considering offshore, increasing your offshore investments now or taking more money offshore now, you've got to think about it very carefully. The rand is one of the major factors you've got to consider as a South African investor when taking investments offshore. If I think back to 2001 when everyone was clamoring to get assets out, subsequent to that, the rand took about half of your returns off by the time you got to the end of 2010. And from the end of 2010 to the end of 2015, the rand added 135% to your returns. So the rand is a chief concern.
Let's come back here to the Johannesburg studio. Andrew, let me come back to you. Obviously, Urvesh talking about the impact of the rand. In terms of products that are available out there, and we want to talk about the impact of a weaker rand or a stronger rand on your investment, but what products are out there?
So to me, look, there's loads to choose from. So from normal rand feeder funds to asset swap solutions to segregated portfolios offshore. So the opportunities are endless. I think what you need to do is you need to look at it from the client's perspective. So for a lot of clients who are earning in rands, who are saving in rands, and in the next years will be retiring in rands, I think it's a very different conversation with someone like that in terms of advice and product and diversification offshore and the quantum thereof, compared to an ultra high net worth client who wants to expatriate 60, 70, 80% of their funds. It's a complex world out there. As you go up the value chain, it becomes more and more complex in terms of the products, the solutions, and so on and so forth. So I think it depends highly on the type of client. And then I think one needs to make sure you get proper advice. And you also mustn't make an emotional decision. So a lot of the offshore investing that we're seeing at the moment is driven emotionally. So high net worth investors getting nervous about what's happening to the rand, what's going to happen with the status of our country, everything else that goes with it. So, and as Urvesh said just now, a lot of investors clamoured offshore, ran for the door in 2001 and took a very long time to make their money back. So try and take the emotion out of it, try to speak to a professional who can help you do that, and then make a common sense decision. So it must be part of a diversified portfolio, the quantum thereof, as I mentioned,
yes,
and then see what the effect is on your long-term portfolio.
Mark, obviously this is where you come in. You're a Chief Investment Officer, and clients maybe will come to you and they're wanting to know where they need to be putting their money. What are you exactly saying to them at the moment? And in terms of safer assets, what would you say is the best asset class to be in this particular time?
To me, the first principle is offshore diversification. So in terms of a long-term strategy, do you want some exposure offshore? At what levels? 25 to 40% is a range. Obviously, you're governed by regulation. Our view is that return outlooks locally and globally for, let's say, the next 12 months is pretty negative. At best, if returns are flat, I think in general that would be, not a bad outcome. There's a lot of risk on the table. So you want some sort of certainty. But I think if you look at all asset classes, there's risk, global equities, global bonds, sovereign risk. You want to be looking in asset classes. You want a more active asset management approach and finding those stocks and those instruments that actually hold value rather than taking a maybe broad market approach.
Urvesh, we know the issues that South Africa currently has, but there are other parts of the world where we are reading about where they've seemed to be faced with their own issues as well. So when it comes to investing offshore, Are there any particular regions where we are seeing investors rushing into?
Yes, well, look, I think to add to Mark's point, it is markets are volatile at the moment, and no matter what sector or country you're investing at the moment, all countries are having a difficult time. In our global equity portfolios at the moment, we like Europe. We like the fact that there's credit growth, there's monetary policy support, industrial production is increasing. You're seeing consumers, after having the austerity measures placed on them, that pent-up demand is coming through now. So we think there's a lot pushing an overweight stance to Europe. And global equity is our favorite asset class. If we look as a South African investor, we're overweight global equity because valuations are reasonable compared to the local market, where valuations are a bit more stretched. And if we look at other global asset classes, say bonds, for instance, there's just no yield available on these asset classes. So you are betting on the currency weakening to give you a return. I think longer term, global equity, despite some short-term headwinds, should give you real returns. And I think investors need to think about generating real returns over the long term rather than worrying about short-term concerns.
Andrew, what about South African companies with offshore exposure?
So obviously that's a great rand hedge as part of the planning. We believe quite strongly from an advisory perspective in once again diversification and then in multi-asset strategy. It makes it sometimes more difficult in terms of a multi-asset strategy when you're looking at offshore as an asset class to then strip out the offshore exposure from company to company in a complete portfolio. What that also does, although it gives you the mitigation against the rand, what it also does is you're still at the whim of people's perception or investors' perceptions of developed versus emerging market economies. So if you're sitting in an emerging market and it's a risk-off play across the globe, then you, even though you've got the rand hedge in terms of those companies, you're still at the whim of those investors who might downgrade all emerging markets.
What about the tax implications? And so as people who are watching this show are thinking, okay, they've given us a couple of points to work with. We know that we can possibly look at South African companies, but the tax implications for that, Mark, is that something you can share with us?
Certainly, I'm not a tax expert, but I think for most South Africans, the offshore allowances are sufficient enough that, as long as you've got your tax affairs in order, you should be able to get decent offshore exposure.
Urvesh, just coming back to you, you said that Europe is looking particularly attractive. I just want to grab onto some of the news feed that's come through. Obviously, the past couple of days, we've seen the banking sector in particular coming under significant pressure. Is this an area that we should be concerned with? I mean, even if you are going offshore, the banking sector globally seems to be one that people are worried about. Are you?
Look, I think the banking sector is very important to a country, and we saw very much evidence of that in South Africa when the banking system was under threat due to the moves from the rand and our bonds. Looking at Europe, the banking sector is a concern, but we're still seeing that consumers their balance sheets are okay. We've seen some deleveraging from the consumer side. We are seeing, in fact, the countries and the countryside, the current account of the peripheral countries are now in surplus compared to the deficit they were. So there has been some structural healing, which means the banks are slightly less of a concern. And look, looking at the other options in the world, the American market's looking a bit expensive. Japan, we had an overweight position there last year, which added a lot of value to our portfolios, and we trimmed that. So we're comfortable with our offshore positioning as we are.
Andrew and Mark, I just want to wrap up by looking at the interest rate trajectory that we've got here in South Africa. Everybody seems to be pretty worried about where we're going in terms of interest rates. Maybe very briefly, Andrew, you can talk us through the type of impact this might have on your investment if you're still invested locally and you haven't diversified.
Look, the increasing interest rates are going to put pressure on the South African market. So first of all, as a result of the consumer being under more and more pressure with increased cost of debt. And then also places pressure on our local market as a result of the discount rate, which is effectively that risk-free premium, which is then used to discount the sort of long-term cash flows of those companies. So that puts pressure on our local market as well. As Urvesh mentioned earlier, the challenge now is when to go offshore and how much to go offshore with the rand having weakened. So I think that's a very serious consideration that an investor needs to make.
Just to add to that, before you go into it, Mark, yesterday we had some of those retailers come out with their numbers, Woolworths being one of them. A very prominent commentator, Sid Vianello, said when it comes to the retailing sector, don't touch it just yet. Maybe you've got something to add in terms of the different sectors, and of course coming back to the interest rate decision or interest rate cycle that we mentioned earlier with Andrew.
Look, it certainly doesn't feel like the right cycle to be hiking interest rates. Generally economies are under pressure, South Africa's under pressure, but I think it's something that is needed. We need to follow what's happening in the world. In terms of your different sectors, I would just say at the moment, be careful of those sectors where the valuations have been high. You've seen retailers run hard. Commodities are still, they hold a lot of risk, but they've been beaten so hard that some of them are actually offering value. So sector play, I think, is an area we've got to pay a lot of attention to within the context of a sort of stock picking type of approach.
Gentlemen, thank you so much for joining us. A very big thank you to Andrew Morton, Head of Product Enablement at FNB Financial Advisory, Mark Lindheim, Chief Investment Officer at Investment Solutions, and in our Cape Town studio, Urvesh Desai, who's the Global Equity Manager of Old Mutual Investment Group's Macro Solutions Division. Don't forget that you can go and get yourself a copy of the magazine. It's available at your nearest store, or if you don't want to, you can simply go online and you can have a look at the magazine there. From the Finweek team, have a great weekend.